Hello, good morning and welcome. You're watching The Mining Show, brought to you by Blytheway on Core Finance, and I'm Charlie Gibson. As you know, when we do these weekly programs, we try and bring you companies whose share prices either risen or we think is about to rise, and hopefully by several orders of magnitude compared to where it is at the time. Well, one such company, which doesn't have a track record, and I'm going to explain that in a minute, it's because it's just gone through an IPO, an initial public offering, so it's come to the market, it's come to the London market indeed for the very first time. And today is the first day of dealings, and if one is to judge from its name, Altus Strategies, then its ambitions at the very least are pretty high, pretty wide. One might even say they were stratospheric. Well, joining me now is the co-founder, Matt Grainger, one of the co-founders I should say, because the other co-founder is Steve Poulton, who is also the chief executive of the company. So gentlemen, very good morning, welcome. Thank you very much indeed for joining us on Core Finance. So tell us your first day of dealings. You've come to the market. You're the first company actually to come to the market to London, mining company to come to the London market for some time. But tell us about the company. What are its projects? What does it do? Where's it doing? Who's it doing them with? And what you hope to achieve from it. So over to you.
Okay, excellent. Thank you, Charlie. A lot of questions there. I guess the first thing to say about Altus Strategies is that we're a project generator company. And this is a different way of doing exploration. It's a different way of doing the exploration model, different way of financing the exploration model. It's a fresh way of doing mineral exploration. So whereas some other companies have come and they've been pure exploration stories and have gone to the capital markets to fund the project, we actually try and find multiple projects and finance those through a joint venture partnership.
So is this a new business plan as far as London is concerned?
Exactly, yeah. It's a very well-known way of doing the business in North America. There's probably 15 or 20 companies like us who are doing that there. We've been doing this for the last 6 or 7 years now, and we'll be the first in London.
So why did you choose London to come to? Why did you choose London to begin with? And why, if that was your model, did you come to London and not go to Vancouver or Toronto or wherever else you could have gone?
We are the only Africa-focused listed project generator company. And we believe that the London market is best placed to serve Africa. Our team and offices are based in Didcot, Oxfordshire, and for that reason we felt that having a homegrown project generator listed in London focused on Africa makes sense. It might be that in due course we have a dual listing in Canada. We wouldn't rule that out.
Wouldn't be beyond the realms of possibility.
Not impossible.
Naturally, you would not seek such a listing, however, if enough of your friends were to indicate to you that was the best way in which you can serve your country and your company, you would, albeit reluctantly, allow your own names to go forward.
Exactly, quite like that. In fact, some of our shareholders are already North American, and so we're very pleased to have the backing of Sprott. And Sprott have just over a 15% shareholding in Altus, and they've been investing in us for the last few years as a private company. And Sprott are well known for backing what they like to think are good management teams who have good projects and who are executing the project generator model. So we're very pleased to have them as a backer, and we also have a number of other North American investors.
So you've raised some money, and what is your share price? What did you come to the market at?
10p.
10p, and you've raised how much?
Just over £1 million, £1.1 million.
Excellent. Now tell us a little bit about the company, where are its projects, what are you doing, with whom, where, why, what do you hope to achieve,
okay.
What's the growth plan?
Yep, for sure. Well, we're focused on Africa. We're currently in 4 countries in Africa. So we're in Ethiopia, we're in Cameroon, we're in Morocco, and we're in Liberia. We have plans in process to get us into other countries in Africa. And one of the key things about our model is diversification. So it's diversification of the risks that shareholders face by investing in an exploration business. And that's a key point about the project generator model, is that they have that diversification. So not only are we diversified by all of those countries, we're also diversified by the commodities. So we have assets in copper, assets in silver, assets in gold, in bauxite, which is an ore for aluminium, in iron ore, and in tin and tungsten as well. On top of that, we already have joint venture partnerships, 2 of those in place, so where those partners are funding the costs of exploration. One of our partners is an Australian-listed company called Canyon Resources, and they're financing to earn an interest in our bauxite discovery in Cameroon. And we also have another company called JOGMEC. It's effectively the state mining bureau of the Japanese government, who are earning an interest in our copper-silver discovery in Ethiopia. And as you'd expect, we're in discussions with other companies about our discoveries. And one of the key things about the cycle and the sector and the project generator model is that we try really hard to be really busy during the downturn. So when everyone else is finding it difficult and hard going and they're all distressed with their share prices, we're being very busy on the ground making discoveries so that when the cyclical upturn comes, we have a portfolio of projects that other companies can earn in on. And because of the way the mining sector is so cyclical, there's been such a lack of investment in exploration over the last 5 or 6 years that the best way for the larger companies to grow is by buying assets or by buying companies. And so we hope to play into that theme in the next few years.
Do you have critical mass, I suppose, is the question that I put. You mentioned a lot of jurisdictions, a lot of countries, a lot of projects there. In the end of the day, you're a £10 million company. You've raised £1 million. £1 million you can spend quite quickly on an exploration project.
We run quite a lean, efficient team, and also across the company and our subsidiaries, we have 16 geologists, so we're a very technically driven team. But we have very modest costs. As Steve mentioned, we're based out in Didcot. We don't have a London office, this kind of thing. So we're able to keep our costs down in different countries. We move our teams from one country to another country as well to make the best use of them. So from that perspective, it's a very cost-efficient way. And in essence, you've got one management team that are running across those 4 different countries where we're operating.
So when's the first income going to come into the company? Because at the moment, what I assume is you have lots of countries, you have lots of deposits, and at the moment you have lots of geologists say, give me a few £100,000, I'll drill a few more holes, that sort of thing. So how are you going to turn that into cold hard cash?
We've actually already received some income. So from the joint venture partners, in the case of JogMeg, we received money at the start of the process, about $150,000. And we also get paid a management fee of 10% for all the costs that we incur on the joint venture. In the case of Canyon, which is the partner on the bauxite project, we also got paid money up front in terms of the joint venture, and we currently hold about 8 million shares in Canyon, which are worth about £350,000 as of today, as income as well. So we have that income as we go through the process of exploration, but ultimately it will come down to if the project becomes successful and it becomes valuable, at some point it'll be acquired, and that's really when our shareholders make money. I think one of the best demonstrations recently in London has been Mariana, where their Hot Marden project in Turkey was acquired as part of the process of Sandstorm, and I think in excess of $170, $180 million. Now, they owned a 30% interest in that project at the time, so it sort of proves the point that you don't need to retain 100% interest to make some very significant money for your shareholders.
So the plan is, I suppose if you want to put that, your plan is to be diluted down on the various projects you have, and so you're turning 100% interest into progressively less, but in return for income.
Exactly.
So there will be no expectation of coming back to the market at any point in the future.
Yeah, that's our model, basically, to ultimately be self-sustaining, so that through income and through the expenditure and use of our own team, we don't have to keep going back diluting shareholders. And typically the exploration phases that the JV partner will bring in will be for drilling, which is where typically the costs are very high for exploration companies to do themselves. Okay,
so but you've explained the model to me. Now sell me the company. Is there a lead project you have? Is there one that's sort of slightly further ahead of the rest? Is that the reason I'm going to buy your shares?
No. They're all good.
Why am I? All right.
They're all good. I mean, it's horses for courses, and that's why we're doing the project generator model, is that because, as we've seen with the lithium space and before that rare earths and before that graphite, the cycle moves and commodities come in and go out of favour, and our view is have a portfolio approach, have exposure to multiple commodities and get other partners to take the risk of drilling those discoveries and hopefully having a good exit outcome for our investors, for our shareholders. So we don't have any one particular asset that we'd like to say that's the best asset of the company. If you happen to not like gold, we have lots of non-gold assets. We have to like gold, we have a number of gold assets. So it depends on the investor as well, what they want to get out. As a management team, that's where we're putting our money into this company. We think it's the best place and the best way of playing the mining sector.
So are you a diversified junior in that?
Effectively, we're a diversified junior, and one of the other key elements about the project generator model is that we get partners to fund the drilling on the projects. Now, there's a big risk with a junior exploration company that comes to market on the back of a flagship asset or two, and they drill that project. Very rarely does a drilling program result in the end of drilling. The next capital raise is usually to drill that project some more, either because the results were good or because they weren't good. And they need to drill a different bit of the asset to justify why, in the first instance, they brought that story to market and that they didn't mislead anyone. Genuinely, the asset might be there. And before you know it, the management team are singly focused on the outcome of that project. And the shareholders go with the outcome of that asset, and often it doesn't work out well. As we know, the mining sector's a fairly risky business to be involved with. And the way we do this, we outsource that emotional commitment to the asset. We don't really mind if the asset doesn't work out. We've already moved on to the next project to try and develop it. Talking about exits and optionality, over time, we'd expect that our project interest would basically evolve into royalty interests on those assets. So you could see a situation that in a number of years' time, we've developed a large portfolio of royalty interests on our own discoveries that's diversified across multiple projects in Africa. And it might be that a larger royalty company might like to have those assets in its own portfolio, and it may be taken for that reason we go as a royalty business in due course. But that's in the future.
All right. But from what I infer from what you're saying is there are two possible exits, and one is the Hot Martin type of exit where someone offers an awful lot of money, or as you say, the other possibility.
Exactly.
And it'd be fair to say that there are a few Canadian companies that have done this, and they've tended to exit via the royalty company strategy.
They have, and it maybe there's some others that have been taken out, so you don't see them anymore. So that because they did, in our situation, we may spin out an asset if it looks like it's going to go somewhere, and we've structured the group so we currently have 5 or 6 subsidiary companies that effectively operate as their own animals, and they go and do their work. And it might be that, for example, we have companies called Aterian in Morocco, Altau in Ethiopia, Alivance in Cameroon, Oramin, which is in Cameroon and Liberia, and a number of other companies. It might be that we take a whole company that's, let's say, the Moroccan venture, and we list that on the Australian Exchange or the Toronto Exchange or here in London, because we think there's a lot of interest for Morocco, for example, and the various projects that we have there. So we have great flexibility in how we play the space, and the management team, we're very much aligned with all shareholders, will determine what is the best way of giving our shareholders exit optionality in due course for the highest possible amount, of course.
So you become a sort of mini Franco-Nevada, and then you hope to be bought by a big Franco-Nevada, for example.
Potentially, yes. Yeah.
It's entirely possible. Yeah.
Just one final question, because we're running out of time. I couldn't help noticing that list of countries that you mentioned, quite francophone. So I'm assuming your French is quite good, therefore.
It's okay.
Okay. Was that a deliberate policy that you were going to those parts of Africa, or?
No, that's a fragment or history of geology and the evolution of Africa. So we're very happy operating in francophone countries. It doesn't really impact on our decisions of where we go.
We like to go to places that are not, fashionable, in the sense that we want to go to places where you can make.
That's quite a long list.
Well, you can make new discoveries. So countries such as Botswana, as a good example, we would tend to avoid because it's mature, and your chances of making new discoveries there are quite slim. So the places we're going to, we want to make large discoveries, world-class discoveries, with which to bring partners in and to make real returns for shareholders.
So contracyclical in more than one way.
Exactly. Yeah.
Excellent. All right, Matt, Steve, thank you very much. I'm afraid that's all we've got time for, but do come back and see us in a few months' time and tell us how it's going, how you find the experience of being listed, having been private, and tell us how those projects are developing. We'll look
It'll be a
forward to
pleasure.
it. Excellent. All right, thank you very much indeed. Ladies and gentlemen, thank you very much indeed. That was Matt Grainger, the co-founder of Altus Strategies, and also Steve Poulton, the chief executive of Altus Strategies, talking to me there. I'm afraid, as I say, that's all we've got time for. You've been watching The Mining Show, brought to you by Blytheway on Core Finance, and we'll look forward to seeing you next week. In the meantime, you have a very capital day.